All right, guys, Disney just reported. They reported 93 cents per share in profit versus expected in 94, so they missed. And they reported 21.82 billion in revenue versus 21.8 on the nose expected, so they beat there. Let's see how the stock is doing after hours. It is currently down 2%. It was down about 3.5 just moments ago. A couple other big numbers. Disney Plus, they have 157.8 million subscribers versus estimated of 163.1 million. So they missed pretty handily there. And they beat on parks revenue, 7.78 billion versus 7.67. Let's pull up their earnings release. Revenues for the quarter and 6 months grew 13% and 10% respectively. All right. EPS from continuing operations for the quarter increased to 69 cents from 26 cents. Diluted EPS from operations. Excluding certain items, diluted EPS decreased to 93 cents from $1.08. All right. So excluding certain items, yeah. Okay, so guys, whenever you look at a company like this, so we as a channel love doing our earnings calls, earnings releases. And the reason we do it is we want to talk about the long term within a short term environment. So everybody's so excited. What's Disney going to report? Guys, let me ask you a question. Is it really going to matter long term if they had 7.78 billion in parks versus 7.67? Now you might sit there and say, well, Paul, these small things matter. Don't disagree. I do not disagree at all. But when you take a long-term perspective, look at any company over the last 20 years, it's grown tremendously. It has not been purely like this. It's been like this. It goes up. The whole point is, are they still able to implement? There are going to be things that are going to happen they cannot control. But if they're good at implementing, if they have a good process, and if they have a good company, they will do well in the long run. Now, let's look at Disney overall. So in the last year, Disney's down about 6%. So look at this chart, guys. We have a 52-week high of 126, and just 4 months later, 52-week low of 84. That's a drop of 33% for a company like Disney. Are you really telling me that this to this, Disney changed that much in value? This is what I want you to remember. I want you to look at this and understand that for a company like Disney, there's no way markets are rational when this happens over a 4-month period of time. And then, oh, by the way, we're going to rebound just a smidge and split the difference. Does that really make sense? So if you're new to this channel and you want the calm feel of buying a great company for the long run, you need to subscribe. This is all we do here. Even though we do earnings reactions, it's still about looking at the long-term thesis of the business. And my questions whenever I buy a company are 3. 1, do I think this company will be around for the foreseeable future? Who the hell does not think Disney's going to be around for the foreseeable future? Ron DeSantis. Okay, besides Ron DeSantis, as I heard in the background over here, I won't get into that right now, but Ron DeSantis is somebody that probably doesn't think they're going to be around, and his goal is. 2, can I gauge what they're going to make over that foreseeable future? I'm not going to be able to get it exactly, but I can offer a wide range, okay? And that's okay to have a wide range. And 3, if the answer to the first 2 are yes, 3, can I pay a reasonable amount of money today for that foreseeable cash flow that gives me an adequate return on my money with protection of capital? If the answer is yes today, then you're probably going to buy the company. Let me ask you this question. The market cap of Disney is $182 billion. If I gave you $182 billion today, could you compete with Disney? Very quick answer. No. I know you might think that's crazy, but you could not. Disney has 100 years of just so much history there, right? They have brands in there, Cinderella, Snow White, Aladdin, all these brands there that you're not going to be able to compete with. That's what gives Disney staying power. But I want you all to remember one thing. It is very possible. In fact, it's usually the way it is that people overpay for a good thing. Why? Because they don't realize that when they buy a stock, they're buying a piece of a business. And when you buy a piece of a business, you're buying a piece of a future cash flow. Now, what's that cash flow worth to you? Well, the more secure it is, you should be willing to pay more. The more they're able to reinvest that cash flow at higher rates of return, you should pay more. Is Disney one of those companies? Well, let's take a look. One thing I'll point out, their 5-year return on invested capital is very low, 4.2%. Guys, I ignore that. Why? Because they were shut down for how long? Now, the interesting part is if you go to the income statement and look at their 4 quarters at a time. Look at this revenue, 19 to 20. It fell by 20%, but we're back at record revenue. However, here's what my concern is. It's almost exactly like Southwest Airlines. 11 billion, 10.5 billion. So with record revenue, they're still only making $3.3 billion. Why is that? That's something you need to understand as a company. But this company's profit is down 66%, even though revenue is 12 or 13% higher than its all-time high revenue. That's something to ask questions about. And that's what I want you doing. I want you to look at these financial statements and have it cause you to go, wait, what's going on here? Why is this happening? Disney Plus exploded during COVID. It crushed numbers. They weren't expecting to have 100 million subscribers that quickly, but they did. I don't even have kids and I have Disney Plus. I think mine came with some sort of subscription of something. I think it was like with ESPN or Hulu or something like that. So that's my thing. But, with Disney Plus, with kids, oh my gosh, it's well worth the money. Look at the number of shares outstanding. I don't know what happened here, but it was a big jump there. And it's been pretty stable since. But they were buying back shares all along the way until they jumped up. I don't think that was COVID. That wasn't COVID. That was before COVID. So maybe they made an acquisition. So let's go to their cash flow statement and see what happened here. 2018 and 19. Was there an acquisition? Yeah, a couple. Nope, nothing. Maybe something is missing here. Let's go to annual. See if there was like just a data. Oh, yeah, right here. $10 billion acquisition. All right, guys, let's take a look at the 8 pillars for Disney. Ooh, we have one check mark here. So, guys, does it mean that Disney sucks? No, just like everything, you have to understand what's Disney going to make money off of. Do we really think their margins are going to be 4 or 5%? That's what their margin is now. Look at their margin. In the last year, 3.9%. No. It's a grocery store margin. That's Sprouts Farmers Market margin. No. In past years, what were their margins? Let's look at past full years. 9, 12.6, 11. So that's 9, 21, 32 billion on revenue of 115 and 785. So what is that? 16, 17%? I don't know what the exact number is. Their margin's very, very low now compared to history. All right. Did I do that math right? Yeah, because 20% of 180 would be 36 billion. They made 33. So it's like 18 or 19%. Guys, this margin is way off. Is that what's going to happen forever? I have a hard time believing that. With Southwest Airlines, I saw the same thing, but then I saw that it was 2 quarters in which their gross margin was like 2% because of all the issues they've had lately with flights and all that stuff. So you got to understand that with Disney, because I'm looking at these gross margins and they're pretty healthy still. So why has the bottom line been more? Let's see, operating expenses, net operating income, other income expenses. There's $4 billion loss here in other income expenses, but I don't see anything else. So I still want to understand why in the last year did they make so much less money. I don't know why that is. So we have to understand that the stock is currently down 2.5%. All right, so let's see what analysts are saying about Disney. Oh boy, look at this. They're going to double their profit in the next. They're going to make $9 a share. So maybe their margins aren't really skyrocketing, because look at $9 a share. They have 1.8 billion shares. Let's round it up to $18 billion in oh, there you go. It's going to rebound then. They're expecting this year the company at 416. Remember, they had 1.8 billion shares. That's $7.3 billion in profit. All right, so it's going to rebound nicely, and it's going to go up from there. But remember, this is where they were before. No, this is where they were before. So it's going to take them the next year to be able to make the same profit. Now let's look at their revenue. All right, it's pretty good revenue growth for a company this size. Mid-single digits, not bad. Now remember, every investment is the present value of all future cash flow. The one thing I want to look at is their debt. So their current 5-year average free cash flow is $3 billion. But let's go look at their cash flow before COVID. Free cash flow. Well, COVID was right. If COVID was here, they actually had less cash flow that year. All right, so they were averaging $7 to $9 billion. So call it $8 billion in free cash flow. All right, I look at these things and think, okay, $8 billion in free cash flow and their long-term liabilities off their balance sheet, because I want to make sure, can their free cash flow handle that debt? Total long-term liabilities, $66 billion. So it's about 8 times more than their average free cash flow before COVID. All right, that's a big number, but it's Disney. And when you have high margin and when you have that moat, it's more likely that their revenue and their profit and their cash flow is going to be more secure. It took COVID affecting 40% of their revenue to have an issue for Disney. And even during COVID, like I said, look at the cash flow. Look at their cash flow during the COVID years. They haven't had negative cash flow. And how long? In the last 10 years, they've not had negative cash flow. Even during COVID, they had positive free cash flow. It's pretty impressive. That shows durability. That shows a lot of good durability. Now, Disney Plus helped with that. When you have 100 million people paying you $6 a month, that's $600 million a month of high gross margin times 12 is $7.2 billion a year. And they're probably profiting how much off that? That helped these numbers right here. Probably still helps this number right here. That's the key there, okay? And the great news about Disney is they have very high quality assets for Disney Plus. They own those assets. All right. So what do we pay for Disney? And let's go to our very famous stock analyzer tool. Now, guys, I'm going to do a wide range here. I'm going to do a 20-year analysis. And remember, our stock analyzer tool was used 1.3 million times last year by our users. It is the most popular part of our software. Without looking at the balance sheet, this will tell you what you should pay for the company based on just the cash flow coming in. I'm not going to include the balance sheet, but it'll give you an idea of if you're even close to a value. Now, I remember in the past, I'd come up with numbers of 80 or 90 bucks a share. Let's find out if that's still the case here with the new data in. So let's put some, and by the way, look at this. ROIC is 7.9% over the last 10 years, and that's with a really crappy 5 years. So I'm willing to bet their normalized ROIC is 10% or more, which is what we want to see. All right. Now, revenue growth over the next 20 years. I'm going to do 3, 6, and 9%. I went 3. Just want to go low, be conservative. 6 is what people basically expect, and 9 if they crush it in some other areas. Profit margin. I'm going to ignore this for the most part. I'm going to put in 7, 12, and 17. Actually, 8, 12, and 16. Man, but they did that profit margin before. What was the profit margin before? Let me do that again. Let me add this all up exactly, because I want to make sure I get the previous free kit, but there's going to be losses along the way probably. So let's see here. 11 plus 12.6 plus 9, 32.6 on revenue of 70 plus 60 plus 55, 185. 32.6 divided by 185 is 17.6. So those 3 years leading up to 2019, they were averaging 17% profit margin. That shows they can do that. All right, let's see if they can get back to that then. Let's go back to Stock Analyzer. And it saved my spot here. Actually, I'm going to do 11, 15, and 19. So I just went and increased it because I'm like, you know what? Even over 20 years, they should be able to beat that 11. They did it over the last 10 years with how many years of COVID really effing them over. So I'm going to stick with that. And with free cash flow, I'm going to do a little bit lower. I'm going to go 9, 13, 17. Now, PE. Guys, the normal market's 15, but this is Disney. They got the moat of all moats. So you got to go higher. If it has a high moat and a high ROIC, you got to go with a higher PE. You got to be willing to pay more money for a great product, right? Disney ain't going away. So the question is where? I don't know, but I'm going to be conservative. I'm going to call it 15, 18, and 21. As they get bigger and bigger, that moat becomes wider and wider. That's why I'm willing to pay 21 times. Now, I would have never said that 2 years ago, but my views have changed on investing. When I find out that Warren Buffett paid 30 times profit in 1987 for Coke as his part of the start of acquisition, that blew my mind. He goes, listen, people love Coke. That's it. They're going to buy it. So you paid 30 PE. Is that the appropriate number for Disney? I don't know. That's for you to decide. That's the art of investing. That's what the conversation we have in our community is about. What's the appropriate valuations and multiples to pay for great businesses? Okay. Now, desired annual return. Guys, I'm going to go with 9, 11.5, and 14. So I started with 9 because I'm like, listen, I really beat this thing up over here. I really crushed this thing. So I'm okay making 9% based on these things happening. Now, as I go higher, my margin of safety's got to go higher. And for these all to happen, I got to get a good return for that. I'm going to want myself to get 14%. And I split the difference in the middle. Now, the stock is currently down 2.8%. I hit the analyze button. Now, before I show you the numbers, remember, if it's all green, doesn't mean go out there and buy it all. If it's all red, just put it on your watch list at the right price. If it's all green, go do some more research. If you want to do research in our community and ask people here, $7 for 7 days, $1 a day. Is it worth it for you to buy a few shares of Disney? Absolutely. So spend your time, spend your $7, go to everythingmoney.com. Here are the numbers. Oh boy, look at this. A low price of 70 to 80, a high price of 170 to 190, a middle price of 110 to 130. Very different than me before. I made very different assumptions, but it's probably telling me that it might be a reasonable price to pay for Disney now. So guys, thank you very much. Just make sure that before you buy it today, you feel like these assumptions above and your assumptions are reasonable. Thank you very much for your time. Take care.